Good afternoon. Wes Ashton here with the November edition of our live update, looking back at what's happened this year. And also, we'll make a couple comments about what's currently happening and what we feel is going to be coming on the pipe in the next couple weeks and next couple months. So first off, before I jump into everything, I just want to thank everybody for joining us here. As I mentioned earlier, it's a foggy Wednesday afternoon here in the city. Fall is definitely upon us, and I know for a lot of folks that I've been talking to, a lot of families now are starting to think about the holiday season. So, looking forward to chatting about what I put together here for the last session of the year. And just so you guys are aware, we will do this again in January. It'll be the recap of Q4, and then we'll do it every quarter thereafter, or as needed throughout the year. So first thing I thought we would do, and there's a lot of noise in the markets. Since we started doing these sessions back in July, we've had some up markets, we've had some down markets. Surprisingly, we're fairly flat on the year over the last 6 months. And so as I was going through putting the PowerPoint together, I came across this quote that I thought was actually timely. And what it says, with a good perspective on history, we can have a better understanding of the past and present, and thus a clear vision of the future. And I know when it comes to markets, when we say clear, I should probably say, clear as mud. It's been a very challenging year, to say the least. It's been a very abnormal year in the markets, and we've seen situations that we haven't seen in 50, 60, 70 years, and they're all compounding into 1 year. So the key points today that we're going to be covering is, number one, again, we're going to look back, year in review. I'll spend a couple minutes on that, and then we'll talk about where we are currently. And then I'll spend some time on the equity markets. And again, I think the word perspective, I think is really important given everything that's been going on. And then I do want to touch base a little bit on recession and points to ponder. I believe, and I said this in the very first webinar, I do believe that we're going to have a recession announced at some point here in the near future. Okay. Some analysts, some individuals say that we might skirt it, but I believe that it will be announced at some point. And to be fair, folks, we could very well be in a recession currently. Okay. And then I promised I would give a few year-end tax tips. I'll give you some comments about what we're thinking about, and then perhaps what you guys should be thinking about as well. So we'll start with where the markets are at. I've started every session with this. Where we're at currently right now is these are all the major North American and global markets. So we have the TSX, we have the S&P, the Dow Jones. We also have the global markets, and we have Nasdaq. And I've also put in here the bond index. So what's transpired for the year, the two best performing markets are actually the most concentrated markets. So I actually had a conversation with somebody recently, and they were benchmarking their returns to the TSX. And they said, hey, the TSX is only down roughly 6% for the year. Well, there's a reason why the TSX has been the best performing market this year. And it's the first time the TSX is actually one of the best performing markets in years. So if we all remember, TSX is a very narrow market. It's made up of three major sectors: financials, energy, and commodities and materials. Those handful of sectors make up almost 3/4 or 75% of the TSX. And the best performing sector this year has been energy. And we've seen gains in energy. We've also seen declines. We went through a period of time where we had a very significant contraction here in the early fall, and then we've seen a rebound on it. So because of that, the TSX has actually fared better because of its overweight concentration to energy. Now, you might say to me, but Wes, what about the Dow Jones? The Dow Jones has done okay. Well, keep in mind the Dow Jones is only 30 stocks. It's the 30 biggest stocks trade on the Dow Jones. So again, very, very narrow market. When you start looking at markets that are a broader diversification, S&P, Nasdaq, which is more growth, but still more broad than some of the first two I mentioned. And even the global markets, markets are down between, 16 to 21%. So when you actually look across the board, we have had a resurgence in the last, week and a half or so, or, we've had a big uptick since last week, but starting at the beginning of October, we've actually had a nice little rally across all the markets. Now, the reason I say this is most of you are starting to get your statements. At the end of September statements that you received in October. September was a tough month. So we got some calls and people said, hey, what's going to happen in October and November and December? But the reality is October was a great month and November has piggybacked on October. And as you're going to get your statements here shortly, you're going to see a lot of our concerns that we had in September have largely been reduced, any anxiety, because we've had a nice little rebound. Now, if we look at what's happened in the market since we started these sessions mid-July in the summer, okay, and I think what's happened for a lot of Canadians, a lot of investors, is the downturn in the market started late last year. So we're almost a year into it. And I'm the same boat. I actually look at my statements every month, and it's gotten a little bit long in the tooth. Every time you open your statements, there's red on your accounts. And what's happened is we feel like every month it falls and it falls and it falls and it falls. But the reality is that over the last 6 months, or since July, 5 months or so, markets, we've actually had winners in the markets, and we've had some that have actually been a little bit slower. But in general, it's been fairly flat. Okay, now it doesn't feel like that. When we look at it, the beginning, when we first started in July, we saw this downturn. And the last, 6 weeks or so since October, we've actually seen it rally back to where it is today. So really, all the noise that's been happening, at the end of the day, it's pretty much flat within the markets. Okay. And now one of the things I actually want to go back one sec, because I didn't actually touch base on it. I talked about equity markets. Here's the fixed income, the bond market. This is a bond proxy that tracks the bond index. Now, guys, what's interesting about this is we know that stocks or equity markets, they're going to contract every 5 to 7 years. Okay. What's unusual during this period of time is we have both stocks and bonds declining at the same time. So generally what happens is when we go through these periods of contraction in the equity markets, people rotate their investments to more secure or stable type securities, which is generally bonds. But again, this is the first time in a number of years where they've actually gone down in tandem. And the bond market's actually on track for one of its worst years since the 1920s. So let's see how it affects Canadians. Now, again, a lot of folks on this call, a lot of folks that we deal with, we don't own a lot of bonds. We might own some bonds, but we also own, alternative investments like pension plans, real estate, private debt, private equity, depending on what the portfolio makeup is. So if you go to just a traditional investment strategy, and this is an example where, Vanguard, one of the biggest financial institutions in the US, if you look at just a portfolio that's broken down between 60% equities and 40% in bonds, okay, and the proxies are the total bond market and the total stock market here in the US, the average blend as of today is down 15.5%. So for a lot of retirees, that's exactly how they've been invested in a more traditional environment. Buy stocks, buy bonds, okay? Now you might say, okay, Wes, this is in the US. And I agree. So let's see what's happened in Canada. So when we look at Canadian peers, and we could have listed hundreds of balanced type investments, but I just picked, one from Scotia, CIBC, RBC, BMO, included one in iShares, which again is BlackRock, which is a large financial institution, Vanguard and TD. And we can see on average, they've all done roughly the same, anywhere down between 10 to 12%. Now there's going to be some outliers that maybe have done a little bit better or a little bit worse. But in general, the average balance type approach has yielded a negative 10% return. And that is the way most Canadians have invested. So in general, this is what, I talked about the fear and greed index from May to September. And I'm going to talk about where it is today in a few slides. So I thought this was just a good perspective. When we started doing these sessions, okay, the first time I showed this fear and greed index was in May 9th. And we can see that for most folks on the fear and greed, there's 7 different indicators. Okay. And this is put on together by CNN. Well, back in May, the overwhelming feeling of investors was extreme fear. And as time has passed, here's July, it moved from extreme fear to fear. And then as recent as our last session, it was in neutral. Okay. Now, again, that just tells you as the market shifts, how the general feeling has been emotionally for investors. And I think you'll be pleasantly surprised what the overall feeling is today. And again, I'll get to that in just one moment. So let's talk about present day. So you'll see some of these slides, for those of you that have been on these sessions in the past, I like to bring back some of the previous slides that we've talked about, just to revisit quickly. And this is one that we've been chatting with families about, and this is just looking at inflation spikes since the 1915. So if we actually look at inflation spikes in history, there's been only 4 episodes that have been similar to where we are this year. Here's this year. Here's back in the 70s. These are back in the 1920s. So the run up to inflation, we haven't seen this in close to 40 years, 40 to 50 years. Okay. Now, on average, the actual run up to the peak of inflation is generally about 24 months. Okay. This was done in July when I pulled it off. We were at 22 months, and it's actually coincided roughly as we peaked inflation that we were coming down. So the good news about the inflation piece, guys, is that we're likely getting ahead of it a little bit. I know there's some data that's still coming out, but what we're seeing most recently is that data has actually been on the positive side. Okay. As it relates to interest rates, okay, and I'll talk about this here. So with interest rates, the Bank of Canada has been hiking fairly consistently throughout the beginning half of the year, beginning actually 9 months of the year. Okay. And I've said this since the last 6 months that I felt that they had to get to their target rate of 3.75, which is where they are today. Okay. Now, I believe that there's still probably 1 to 2 more rate hikes before they actually pause for a little bit to reassess the economy. So I actually believe the Bank of Canada will hike between 25 basis points to 50, which is 0.25% to 0.5% between now and when they end. Okay. And I believe in the US, they'll probably hike a little bit more because they're a little bit behind us. Canada started hiking before the US started hiking. So when we look at it, it's not so much the rate hikes, but it's the pace of the hikes that have really been difficult. And if we look where we are today, the red or burgundy line here, it just shows how quick, okay, how much velocity of the actual interest rates that we've had in the first portion of the year. And it actually goes back and looks at all the other times when we've been in situations where there's been significant rate hikes. And back in the 80s, and again, 1980, 79, 80, we've seen really significant hikes. But everything thereafter, with the exception of 1973 and 74, they've all been much more gradual. Here is the most recent one before now, which was in 2015 and 18. We can see that they hiked over time, but it was much more gradual. Okay. So the pace of hikes has been actually difficult. And the problem, when you look at debt, mortgages, line of credits, and so on, for a lot of folks on variable rates, their payments have gone up by 50%, as opposed to a little bit month after month after month. So as opposed to being able to address it in their budget, they've had to actually make some changes in a very short period of time. Okay. So again, this is just on their inflation side. So again, the US inflation and Canadian inflation, for those of you that aren't following it, here's where it peaked here. It was just a couple months ago. Okay. The US data came out last week, November 10th. For several of you that maybe follow the market, you saw that we had a very significant uptick in the market on November 10th. I'll talk about that in just one moment. And then we had good actual data again yesterday out of the US. And all signs is pointing towards it leveling off a little bit. So we have hit some peak inflation. Currently, it's on the downtrend, which is positive. And the reason why the markets have already moved is because the forecast of interest or inflation has been high. It was an expectation that the US Fed was going to continue to hike at a rapid rate. But because it's actually been less than what was anticipated, the markets were expecting a 75 basis point rate hike. But what's going to likely happen when the US Fed announces next, it'll probably be only 0.5%. So it's actually going to be lower than anticipated, which is why we're seeing the markets have an uptick here in the last week and a half or so. So here's the S&P 500. Believe it or not, I said there's been some anomalies. It's been a very unique year. So the most recent CPI data that was released on November 10th, the S&P 500 had the largest gain for the day that the CPI was announced. And here's the example. So in November last week, 2022, the gain on the S&P 500 was 5.5%. There's never been another day that CPI has been announced where the S&P 500 has had that big of a gain. It was, again, where we're dealing with historical movement on the market right now. And here's just a snapshot of the three different markets as a result. So we can see in November 9th, November 10th, we had a downturn. And then November 10th, we had significant upside on both the Nasdaq, S&P, and the Dow Jones. And when you specifically look at the Nasdaq, which has been the worst performing major market this year, okay, and this goes over the last a decade, okay, there's only been 5 other occasions where we've had a 6% move on the Nasdaq. Well, check this out. This was November, right here. And we had 4 of them back in 2020 during COVID. And then 1 back in 2018, 2019. So even though there's only been 5 other occasions, 4 or 5 of them, or 4 of them happened during COVID. So again, not only is the S&P 500, having historical movement in the markets, here's one with the Nasdaq, which we don't generally see too frequently. And then again, I really want to spend a little bit of time on this because, coming out of the September statements, a lot of folks will say, hey, you know what, are we going to have growth? Is it different this time? Well, here's an example. Again, by being patient, investing the portfolios with an investment strategy that we set forth before we got into this downturn, buying good quality companies and preparing for this, as opposed to going into cash or going 100% equities. We just said, hey, let's make sure we maintain a disciplined approach. The benefit is our clients, our families are benefiting from some of these days. So again, if we go back, the 5.5% move on the S&P 500 was the 15th best move in history. Okay, let that just sink in for a sec. Out of all trading days since 1950, so 1950, 72 years, okay, close to 25,000 trading days, actually last if you deduct the weekends, 20+ thousand trading days, this was the 15th best move in 72 years, okay? And what that means as well long-term, and I think this is actually, again, not just looking at where we are today, but looking out into the future, historically, what has happened? So if we actually look at the S&P 500, when there's a movement of over 5%, okay, and this goes back to the same thing. It's the same chart since the 1970s, and this one's done in chronological order as opposed to the amount it moved. Well, what's actually really interesting with this is when you have the day that moves by 5%, if you look at 1 month out and 3 month out, there's lots of positive periods, there's lots of negative, but when you get out 12 months, which isn't that long, guys, 91% of the time, the markets are positive. And some of them are positive by a significant amount. Okay, the only times that we really had a 12-month out that was still negative was in 2008 and 2001 during the tech wreck. But every other period in time over the last, I don't even know how many days are here, it's been positive over a 12-month period. And it's been positive on average by 27%. And again, as I mentioned, positive returns have been posted 91% of the time. So I'm not saying what's happened last week is an indicator of what's going to happen in the next 12 months. But if you look back on history, it gives us a pretty good idea of what's happened in the past. Okay. So there's some reasons to be optimistic, even if we go through some headwinds here in the short term. And then the last one here, before I get back into that fear and greed index, I've had some people ask about the presidential cycle, the presidential election. So obviously we just went through the midterm elections, and now we have the next 2 years before the election. So generally, if you look at what happens over the period of the 4 years of a presidential election cycle, the first and second year are somewhat flat. We get a little bit of gains, but really in the third and fourth year, the markets have a much more significant upturn. And where we're at today, this is as of September 19th. Here's where the market is today. It's probably actually up a little bit up here now. Okay, so it is trending upwards, very similar to this, but it still is lagging behind what we see historically. So when you look at where we are currently, I go back to it. There's a lot of reasons why, we can be not overly optimistic, but we can have a more clear outline and say, hey, you know what? Instead of actually making really knee-jerk reactions, if we stick to a good investment plan, we're going to participate in this upside. And when we look at the fear and greed index, as of today, I showed you where it was 6 months ago. As of today, it's actually shifted, and now it's actually showing greed. So what that tells you is the optimism in the market is much better today than where it was, 6 weeks ago, 12 weeks ago, 6 months ago. Okay, so I'm going to switch gears here. I'm going to talk a little bit about the crypto markets. I'm going to talk about the crypto markets because I've had some feedback on the last webinar where people said, hey, can you talk about it? And it's been a really interesting week, guys. If you're not following it, there's a lot of disruption in the crypto markets right now. Okay. And one of the things that I, again, just looking at some cartoons here, like I said, I came across this and I just thought it was, I got a good laugh out of it. Definitely still too hot. There's a lot of uncertainty surrounding digital currency or crypto markets right now. So here's where I'm going to talk about Bitcoin and mostly Ethereum. I'm only going to spend like 2 or 3 slides because for a lot of you, you do not own a digital currency. But for a lot of you, you've asked questions about it over the last 12 months. And this is a good example of emotions, leading investment decisions for a lot of Canadians. Last year there was this, FOMO, fear of missing out, where a lot of folks said, hey, it's going so well, I think I need to own some of it. And it's okay over the long run. Like I said, I think there's a place for digital currency, but from an investment point of view, it's tough. There's a lot of speculation. It's unregulated. And because of that, we see a lot of growth, but also a lot of pain in certain periods. So for those individuals that have bought in the last year, okay, and this is here the 53 weeks, Bitcoin is down 75%, and Ethereum isn't actually much different. And these are the 2 biggest digital currency. Okay. Now, what's transpired over the last week, for those of you that aren't in the loop, FTX, the 3rd largest digital currency exchange, they've filed for bankruptcy over the weekend. Okay. And so what's come to light is a lot of the ways that the crypto exchanges work is they use a lot of leverage. So what they'll do is they'll take their deposits and they'll lend it out and invest it. Okay. And what happened with FTX is that there was a run on withdrawals. And what happened was there was more requests for withdrawals than they had money in the bank. And so what happened is FTX had to essentially try and be bought out by a competitor. And then they stepped away from the deal, and the FTX has had to suspend any withdrawals. And it looks like anybody who had assets on their exchange, it'll go to 0. Okay. Now we've seen, stable coin earlier this year with what's happened there. That's gone to pretty much 0 earlier this year. And now what we're seeing actually with in crypto is we're actually seeing some contagion. And what I mean by that is because it's like a house of cards or a dominoes, because this one has fallen. Now there's other exchanges out there that people are getting a little bit nervous about actually having digital currency. So now they're asking for withdrawals, and it's at such a rapid pace. These other crypto companies, they're having to pause redemptions. They're having to pause redemptions to make sure that they have the liability or the assets to offset the liability, which is the withdrawals. Okay. And so when we look at Bitcoin and Ethereum since November 5th, they've fallen just 20% in less than a week. Okay. So again, I'll comment about this at the end. Like I said, I've seen a question that's actually popped up here, and I'll circle back and I'll answer the questions at the end. So, all right, so let's talk about equity markets and perspective here. So again, I really want to stress how much of an anomaly this year has been. Okay, we are actually experiencing the markets. We might be experiencing years of what happens in the markets all within 12 months. So again, it beats us up a little bit because we're seeing these rare movements on more than one occasion. I talked about the Nasdaq. I talked about the 5% up on the S&P 500. These are anomalies that we don't generally see all compacted into 1 year. Okay, so when we look at the S&P 500, here's a great example. So the S&P 500, when you looked at the number of days with a decline exceeding 1%, it's roughly the 5th largest since 1974. Okay, we've had almost 60 days on the S&P 500 where it's declined by 1%. Okay, now keep in mind, I showed you that graph earlier where the net result, S&P was down roughly 16%. So what's happened is they've had these, roughly between 50 to 61% declines, but we've also had a lot of gains that have actually made back a lot of that. But again, put it in perspective, every day we're getting hammered with, hey, another 1% decline, another 1% decline. And what happens is we forget about some of those winning days that actually have clawed back a lot of those 1% declines. Okay, so here's another one. So again, you guys might be thinking, hey, Wes, I get it. You know, you keep on hammering this back, but you know, I think it's important, again, perspective, because what happens is we look at our statements or we just watch the news and we feel that it's so negative. Okay, and it has been, because that's how they sell. So they sell advertisements. That's how they get you hooked, is on negative news, which I'm going to actually show you when I talk about the recession. So here's another example of the intraday swing. So the S&P 500, okay, and this is in October, okay, it had the biggest intraday swing, one in the top, 1, 2, 3, 4, the fifth biggest intraday swing that it's had in its history. Okay, or sorry, since 1962. So in almost 60 years. So what do I mean by an intraday swing? So if the market is down through the day at, you know, in this case, 2.39%, throughout the day, it actually clawed back that 2.39 and was up 2.6%, which means it had a 5% swing from bottom of the market during the day to where it ended. Okay. And so it's really important because, again, if we're watching, you know, nowadays, you can actually see everything instantaneously. You can see it on your phone. You can listen to it. You can see it on your TV. We're bombarded with information today, and it happens very quickly. So, and this is the reason we actually see Canadians make mistakes within their investment portfolio, because they're trying to digest this information that's coming at them, you know, in minutes, and they're trying to make a decision based on what's going to go on for the year. And so for a lot of Canadians, what happens is they actually hurt themselves. They sell when they should be buying. They buy when they should be selling. And so as opposed to trying to subscribe to timing the market, guys, and you've heard me say this often, let's build a good, sound investment strategy based on what we're trying to accomplish. And we recognize the markets are going to go up and down. There's just no way of getting around that. Okay. Now, if we go back just to the basic principle, and guys, I'm just getting off topic here a little bit, so bear with me. You know, I often say to people, like, you know, not a lot of individuals invest for fun. Okay. Some people do, because there's a rush and so on and so forth. But most individuals, they invest, or they take their money and they invest it because they have to keep up with tax and inflation. That's the key reason. Okay, so right now, inflation is really high, but on average, if it's roughly 2, 3, 4%, or depending on where we are in the cycle, that's what we need to actually beat. Because what happens is gas goes up, groceries goes up. So we actually have to have our money to be growing so that in 5, 10, 15 years, when we need to buy services or products or goods, our money is actually growing at the same pace, or roughly the same pace. So when you go back and say, how do I need to invest my money? You know, up until today, most GICs were paying less than 1%, 1.5%. Today it's higher. Okay. But in the past, you couldn't keep up with tax and inflation based on just keeping it in the bank account. So you had to do something with it. So you could buy real estate, hard assets, real estate. You could buy gold. You could invest in bonds. But again, we knew bonds, as rates went up, bonds would go down. So that wasn't great. So the only way for us to actually outpace tax and inflation, at least in the last decade, is to actually own stocks. And if we go back historically, we need to own some portion of our investments in companies that we understand. The problem is that from time to time, those companies are going to contract, but on the long run, they're actually going to grow. So we're in a period of contraction. And if we actually walk through a lot of what's happened, the investment strategy has performed exactly as we expected, and actually a little bit better. You know, it's dropped less than the market. And when markets go up, we want to participate on the upside. So if we look at just an average bear length, so again, I'm talking about the contraction piece. What's interesting is if you actually look at where we are today, okay, which started at the beginning of the year, we have 284 days of the actual bear market. Okay. On average, if we go back over all these years and look at the bear market, the average bear market is at 287 days. So based on the average, I believe we're going to be a little bit longer than the average. But what this actually tells me is that we're actually getting through the bear market. And we got to go through this period of contraction before we can come out the other end. Okay, so right now we're at the average length of a bear market. And I believe the future looks rosier than if we look in the rearview mirror. I believe we're a better position for growth over the next 6 to 12 months than what we were the previous 6 to 12 months. Okay, and then from a valuation point of view, guys, so again, this is the S&P 500. So what I mean by valuations, you know, historically what happens is, you know, if you look at a company, you can determine whether that company is fairly valued, overvalued, or undervalued. Okay, and if we look at this from a historical perspective, the average S&P 500 PE ratio has been roughly 14.5. Okay. Or 16, I'm sorry, over the last 25 years. Currently, it's sitting at 14.5, which says, if we look at historically speaking, where the valuations have averaged on the S&P 500, we're actually below that now. And we're at a level now that we haven't seen since roughly 2013. We hit it in 18 briefly, but we have to go back almost 9 years to actually see the valuations of where they are today. So I'm going to actually break this down one more time just to kind of give another example. In 2008 and 9, for a lot of you on this call, we went through a fairly significant contraction in the great financial crisis. Well, the biggest issue, because in the US, obviously Lehman Brothers went bankrupt. In Canada, which has a much different financial industry, financial sector, what happened in the US, everybody believed was going to carry over into Canada. So if you remember, our Canadian banks, the big 5, 6 Canadian banks were down 60 to 70% at one point over that contraction. Well, guys, when you looked at their PE ratios, they were trading between 6 to 7 times on average. Historically speaking, they were trading at 14 times average. So in that period of time, those banks were actually 50% off. And in some cases, if you looked at BMO was paying a 13% dividend at that point. And there was a lot of uncertainty because people weren't sure if BMO or the rest of the Canadian banks were going to cut their dividends based on the contraction. But they steadfast. They kept their dividends at a reasonable amount. And we've seen what's happened with those Canadian banks over the last decade. Okay, so that's what I mean by price to earnings ratio, the PE ratios that we look at. We're getting to the point now in the US that are becoming much more attractive. There's more companies on sale. Okay. And if we look globally, so as a comparison, globally, it's the same trend. So right now we're actually seeing global PE ratios that we actually haven't seen probably close to 20 to 30 years. Okay. So stocks are getting cheaper, which is actually good. All right. I'm going to pause there for a quick set. If you guys need to grab a drink, what have you, I'm going to jump into just the recession piece because I think this is actually timely. And then I'm going to just jump into some key tax reminders and then I'm going to open it up more for questions. Okay. I actually have a question here. So let me just double check, look at this question while you guys are maybe grabbing another water or what have you. Okay. Actually, this question actually, and I'm going to actually just comment about what the question is because it ties into this section. So it's a great question. So it said, hey, I mentioned a recession should be announced soon. Can we expect another significant short-term drop in the coming months before stabilization and growth? Okay. And do we see a strong buying opportunity with that? So a fantastic question. Okay. So the recession, so points to ponder. So really what I wanted to focus here with the recession, folks, is how we react. Okay. And from a human nature point of view, I came across this article. I was looking for some information. It's a little dated, but it proves my point. Okay, we have what's called negativity bias. All right. As human beings, we actually gravitate more to negative news than we do to positive news. Okay. And I'm going to give you a very simplistic example on the next slide. But here's an example where they did a study and they looked at the McLean's weekly newsstand sales figures. And they looked at the magazine covers that had negative news. And they looked at the newsstand, the covers that actually had positive news. And what's interesting, the ones with negative news sold way more copies than the ones with positive news. And again, it's proven that as humans, we actually, again, we focus more, we pay attention more to negative news. Okay. And it's no different. They did studies, this was years ago, but on the financial markets. At the financial markets, and I can't quite remember what the percentage was of the break point, but I think it was if there was a move of 2% on average in a day in the market. What they did is they tracked where that news ended up, and they found that the news ended up on the first or second page. And this was back when everyone was getting newspapers. But when the actual market moved 2% in the positive direction, on average, they found that the actual news was actually put on page 7, 8, 9. Okay, because they recognized that viewerships, responded more to negative news. And so here's the next thing I want to show. And I'm going to use this as an example. So I don't know about you guys, but I can recall news stories where, there's been a shark attack or victim in wherever it is, Hawaii, Australia, whatever. Okay. And I'll often look at my family. I'm like, oh man, we don't need to go to the beach today. If we're there, we get emotionally involved or charged with it. Okay. But what's really interesting is we hear about those shark victims. We hear about the shark news, but they're not the most vicious. Okay. And what's interesting, if I had to have you guys guess of these three animals, which one has the highest amount of deaths related to them in the amount? How many of you here, and again, you can't show, but just give us some thought. How many of you would actually pick the shark or the lion? Okay. So check this out. I actually found this amazing. So sharks, they account for 6 human deaths a year. Okay. In most recent data. That's it, 6. Yet I bet you most of you sitting there, and you're probably nodding going, yeah, I remember those news stories. Well, a lion, they account for 22 deaths a year. Okay. Well, how many do you think a hippopotamus? I can't remember the last time I saw a hippopotamus news story. I mean, can anybody here? Probably not. Okay. The only thing I ever think about the hippopotamus is when the holidays around the corner and we all want a hippopotamus for Christmas. So hippopotamus is more vicious than these other 2 animals. 500 human casualties a year with a hippopotamus. But that doesn't sell newspapers. That doesn't sell media. So again, this goes back to negativity bias. They stick the negative news at the beginning of the actual newscast because that's what we're going to pay most attention to. And the reason I bring this up emotionally, guys, is because when they announce a recession, and this ties into the recession, is that when they announce it, and again, typically with recession news, it looks backwards. So what I mean by that is they're going to get the data. The definition of a recession is 2 negative quarters of GDP growth or a slowing of the economy. But often what happens is they get the data and then they look back and say, actually, you know what? We've actually been in a recession for 2 months or 3 months or what have you, whatever it is. It's not generally we're in a recession at that point of time. It's usually backwards looking. Okay, so when they announce a recession, I believe that the media will be all over it. Okay, and they're really going to focus on the economic numbers. Well, those numbers are already here today, guys. So we can actually see what the data is telling us today. But what's going to happen is that they announce it in the next 4 or 5 weeks or earlier, or whatever it is, they're going to go back and say, hey, remember when we had all this bad data in the economy? Guess what? We were in a recession. So the question again is, how do people react? And I do believe that we might get a little bit of a short-term hiccup because everybody's going to be looking at, oh my gosh, now we're going through this period of contraction. Okay. So again, I believe what's important is we have to recognize markets lead us into a recession, which is what they've done. Markets lead us out of recessions. And I'm going to talk about that in 1 second. Okay. So again, just put it in perspective. These are charts, some of you have seen. These are all the recessions since the 1920s. Okay, quite a few of them. 2020 was the last one, really narrow, very event-driven with COVID. The previous one before that was 2009. But again, if we put it in perspective, when recessions are announced, the markets in general, they do go up over time. Okay. And then again, for a lot of you, you may have seen this one. This goes back to, again, emotions and actually buying and selling at the proper times. So again, I'll address this for people that haven't seen it. I won't spend a lot of time on it, but I'll give you an update. So what this chart shows is the TSX. That's the blue line. The bars, whether it's on top or below 0, is the inflow and outflow into investments over those periods of time. Well, what's interesting about this is when you look at all the dips, okay, here's in 08 and 09, here's in 16 and 17, here's in 2020, a lot of the actual withdrawals accelerate at some of the worst times, which means people are selling when their portfolio is low. And then what happens is they don't start buying again until things get more attractive. So as an example, here's 2008 and 9. There wasn't net inflows into the market for almost 2 years. Okay. And what's happened is they've sold out in here, and then they bought back in here. So they've actually crystallized this downturn in here. It's the same thing here and here and so on. So it's really important that we work with our families and we make sure to have really good conversations, explain the pros and cons of whatever direction that they might be feeling, and understand what the benefits and drawbacks are of each. At the end of the day, folks, if you wanted to be more conservative and have cash, we can do that. But again, I believe that, by going into some more conservative investments, again, if you're selling equities, selling stocks to go into GICs, or to go into just simple cash investments, it's really easy to get out of the market. It's tough to get back in because we always think that there's always going to be another shoe to drop. Markets go up, even right now. I don't know if we're in the midst of the beginning of a bull market until we look backwards. But I could also say, yeah, well, you know what? I think it's going to come back down, so I'll wait. Well, when the market does have an uptick and goes into that full kind of upside kind of movement, the problem is that a lot of folks will still be sitting in cash and they'll wait and they'll wait. And then they'll finally, just like crypto, what'll happen is they'll say, hey, I don't want to miss out anymore. And then they invest back in. Okay. So again, really important that we recognize we have these these periods. We position the portfolio in a way to stem some of the declines so that it's positioned well when things improve. Okay. And then again, this is a reminder chart, but for those of you that haven't seen it, okay. And again, when this question that I just had, if we do get that contraction, okay, well, what happens in a recession? So here's a good example of 2009. Okay, the Canadian economy was in a recession here. Okay, so March of 2009, the bull market started, right? And we can see that quick velocity at the beginning. So for a lot of folks that were in cash, they were so beat up from 2008 and 2009. When we saw this trend, a lot of folks that were in cash said, yeah, but it's going to come back down like it has before. This is where I'm going to get in, and then it's going to go back up. Well, in 2009, it just kept on going back up. Even though the recession, we were in the full swing of the recession, okay? And so in July 23rd of that year, 4 months after the bull market started, okay, the Bank of Canada basically came out and said, the recession is over. We've looked backwards. The recession actually ended, a couple months back. Well, in that period of time, major markets grew between 38 to 55%. Okay, all whilst being in a recession. So this is what I'm saying. Right now, markets have led us into a recession. Markets are going to lead us out of a recession. Okay, and we don't know we're in a bull market or an upward trend until a few months go by. So we just really want to be mindful of that. Okay. So I'm going to talk about some year-end tax tips. And I'm going to circle back to the questions. And sorry, somebody just made a comment that made me chuckle. I'll talk about it in a second. So year-end tax tips, guys. So for us, we're starting to think we have 6 weeks left to the year. There's a few things that we're doing internally for our families. Okay. We'll be reviewing everybody's accounts in terms of where they're sitting today. Given the year in the markets, there's going to be an opportunity to do some tax loss harvesting. Okay. What I mean by that is if we have positions in a non-registered account or a corporate account, and they've actually contracted this year because of the markets, we can actually look at moving them from one investment to another and crystallizing that loss on paper. So you might be saying to me, yeah, but Wes, you just told me I don't want to crystallize a loss. Kind of. I don't want our families to crystallize a loss going from the equity markets to go into cash unless they need to be in cash for a specific reason. But what I do want to do is I want to set our families up from a tax perspective. So let me give you an example. Let's say we own TD Bank, okay, the stock, and TD Bank is down 20% this year. So if TD Bank is down 20% this year and there's a paper loss, we can actually trigger that loss and we can even move that TD Bank to Royal. So same sector. Okay, so we're if the financial market goes up, both of them are going to likely go up. Well, by making that move between the two investments, the clients haven't lost money because if they had 10,000 in TD, they would have 10,000 in Royal. But by making that change, we've now created a paper loss. Now that can be used against capital gains throughout the year, or if you don't have it, they can be carried forward forever and used against capital losses in the future. Okay, now for some of you, maybe you sold a rental property, maybe you sold sold a business maybe in the last couple of years. The other benefit of tax loss harvesting is you can actually take those capital losses, and if they're significant enough, you can actually apply them to previous year's capital gains. So you can go back 3 years. So the benefit is we can get some money back from the government. Okay, so tax loss harvesting, we will review every non-registered account over the next probably few weeks. And we'll actually make some switches in order to create some of those tax losses on paper for our families so that we can actually reduce the amount of tax they're giving to CRA. Okay, that's number one. Number two, some of you on this call may want to be doing a registered plan withdrawal. Okay. Now we've already been talking to our clients about this, our families about this. So what I mean by that is if you have really low income this year for whatever reason, okay, the tax bracket at around 40 odd thousand or so kind of jumps up to that middle tax bracket at roughly around 45 to 48,000. So if you have very little income, okay, the basic exemption amount that we have as people in BC is roughly 14 to 15,000, which means the first 14 to 15,000 that we make in BC, we do not pay tax on. Okay, we might have tax remitted, but that's the basic exemption amount that we have. So if we have a family that one of them is below that threshold, well, we can take out money out of the registered plan, and virtually you're withdrawing it tax free. Okay, you might pay some tax now, but you're going to recoup it later. Okay, for those that are between the basic exemption and, like I said, maybe that 40 to 45,000, if we know that the income is going to be higher in the future, we might actually decide to actually withdraw a little bit of a register plan today, pay a smaller amount of tax versus what you're going to pay in the future. Okay. And this is why it's important for us. And we talk to all of you throughout the year, when we try and get a better understanding. This is the reason we ask about your income, so we get an idea of the tax. So if there's anybody on this call that you're unsure if this is applicable to you, feel free to flip us an email and we can review it, make some suggestions. Okay. Number 3. Okay, there's income splitting opportunities. So not only when you file your taxes, you can split if you meet the criteria. So any pension income can actually be split in between spouses or partners. Okay. The other thing you can do too is actually with income splitting, you can actually put in place spousal loans, which is where one spouse or one partner lends to the other partner. You can actually lend to family members. The only caveat is CRA wants the person that is borrowing the assets to pay a nominal rate of interest back to the person that's giving it to them. So I'll give you an example. My wife and I, okay, Diana and myself, if I have cash and she's in a lower tax bracket, instead of me keeping the cash in my name or the investments in my name, it's usually more of a substantial amount. I can't just give it to her because the CRA doesn't like me to take it out of my higher tax rate and just give it to a spouse. But what they allow me to do is I can actually lend it to her. So I can just open an account in her name, or she can open an account. I can lend it to her via a spousal loan. But because she's basically borrowing the money, that's how it stays on side with CRA, she would have to pay me the prescribed rate, which is roughly 3%. Okay. So for me, it's taxable. For her, it's a tax deduction. So the benefit in some cases, these spousal loans make a lot of sense. So this is something from an income splitting point of view, you might want to look at maintaining and maybe even implementing it, because the prescribed rate is likely going to increase as the Bank of Canada continues to increase the interest rates. Okay. Number 4. So I talked about tax loss harvesting. So same thing. Maybe it's a year where we're doing some capital gain triggering. So again, it goes back to what's your income? Can we afford to actually trigger some capital gains? Try and do it out over 2 years. Instead of instead of doing it all this year, you do some this year, some next year. But again, it all goes back to what your tax situation is. So there might be a situation where you might want to be triggering some capital gains. Okay. And then number 5, in-kind charitable donations. Okay. So if there's anybody on this call that they have some wishes on the charitable side, what you can do at a non-registered account is you can actually donate them in kind. So what that means is you don't get stuck with the capital gain on that investment, and you get the tax receipt. So charitable donations at the end of the year, whether it's in kind or just making them, can help you for next year's tax situation. Okay. And then this isn't a tax tip, but it is something that just came out. I thought I would mention it. So the 2023 TFSA contribution amount was just confirmed yesterday, I believe, day before. Because of the CPI, because of the inflation rate, it's actually bumped up to $6,500 for 2023. So for those of you who will make a lot of those TFSA contributions on your behalf, but again, it's moved from $6,000 to $6,500, and I believe it's now $88,000 roughly is what a family can contribute going back to 2009 onwards. Okay. So that's about it. So I'm going to open this up for questions. I've been getting a few in here. So first of all, again, if there's some of you that are actually choosing to jump off, no problem whatsoever. But sometimes we get some great questions here right near the end. I'll answer 3 to 4 of them and just try and give some perspectives. For those of you that we don't get to, if we happen to have your name with the question, we will reply. Or if any of you have questions specifically for me, just flip me an email, myself, Lidan, or what have you, and we can get back to you with some comments. So, Okay, so I have another screen to my right. I'm just gonna look at the questions here. So again, I talked about the recession. Do I think there's going to be a contraction? Possibly, again, depending on what happens from media. And do we see strong buying opportunities? I do. I do see it. I see it today. We want to be mindful of it. We want to make sure that we're trying to pick up companies that are good valuations. But again, we're not going to be able to time the market perfectly on the bottom. But if we can get them at reasonable prices, then again, I believe if we're investing for the mid to long term, and by the way, when I say long term, guys, I don't mean 10, 20, 30 years. Long term could be 7 to 10 years, which is just the next cycle. So actually, I believe that on the next cycle, even if we invest today over the next 5 to 7 years, investing and averaging down on certain investments will have a very positive effect on our family's portfolios. Okay. I have another one here that says, what should we anticipate prior to the 2024 elections? Man, I wish I had a crystal ball. It's a great question. For those of you that haven't heard, Donald Trump has thrown his name into the ring as of, I believe it was yesterday. So it'll depend. It's very fluid. The U.S. politics nowadays is very fluid, and so it's really difficult to predict. So I would say, we just have to be mindful of it, and we're going to get a better idea as we get in closer. If we go back to that previous graph, I believe as we lead up to it, I think we'll see some good growth in the markets, but time will tell as we get closer. And if we have to shift the portfolios or try and take advantage of what's going on, we'll definitely do so. So the comment that I had a good laugh about is when I talked about sharks, lions, and hippos. Somebody had mentioned that the worst killer is the mosquito, which is true. I didn't want to put on there, but surprisingly, mosquitoes represent casualties of almost a million individuals a year. So the smallest insect is actually the one that, again, we don't see on the news because, again, it just doesn't sell the media or the advertisement. So, okay. And then I have a couple here. Again, looking into the future, what do I think interest rates will be by the end of February 2023? That's difficult, but again, I believe there's still probably another 25 basis points, 0.25 to 0.5% to go. So I believe that the Bank of Canada is likely going to get to 4 to 4.25. That's what I believe. And then from there, I think they're going to pause and have a look at the impact on the economy before they make a decision if they're going to raise more. One of the positives, by the way, I forgot to mention this. One of the positives about them hiking so aggressively at the beginning, it actually gives them a lot more flexibility to actually reduce rates if they need to, if the economy is sluggish. Okay, so if they're sitting at 4 to 4.25, I wouldn't be surprised if all of a sudden we get a 0.25 point reduction, depending what happens with inflation. Because at some point, depending what happens in the economy, they may want to start stimulating it somehow. And one way to start stimulating it is to get more money in people's hands. So one of the monetary ways they can do that is to reduce interest rates. Okay, there's other ways to do it as well, but the most obvious one is just to make a debt more serviceable. So, okay. A good question on the next one here. Do I have any info regarding the Canadian dollar versus US dollar going forward? It's interesting. I should have actually added a chart on this. So most recently, the US dollar has been falling. Okay. I would actually anticipate it to continue to fall somewhat here in the near term, but I don't see excessive contraction on it. We can send out some information on this. We'll get some reports, but again, quite fluid, with the inflation talk, crypto with gold, again, it's quite fluid, and we're seeing movements in currency actually quite significantly that we don't generally see. But I think here in the near term, and I mentioned this in the last webinar, I think it will contract a little bit before maybe it levels off. And then the second piece of that, if we do go through a period where we get a lot of volatility globally, generally the US dollars is seen as a safe haven. So what we tend to see is people tend to rotate, or investors tend to rotate into more stable assets when there's more uncertainty. So we could actually see it contract here in the near term. And then depending what happens when a recession is announced, or depending from an economic point of view, that's where I think it might level off a little bit, just simply because the demand might be a little bit more in need versus what it would be at this point in time. So, perfect. Okay. And I just had actually one other one here, actually two. So one, I had a question here about GICs. So someone said, hey, a 1-year GIC, I can get roughly 5%. What are my thoughts on it? So again, it depends on your situation. All right. GICs, it's nice to get a predictable 5% or 4%, whatever it is, yield. Okay. The drawback, and I said this last time, I wouldn't actually lock in any money right now. I wouldn't want to be locked in for a year at 5% because I think the opportunity in the markets will be greater. So what I would do, or what I'm suggesting for folks, is you keep it a little bit more fluid, a little more liquid, as opposed to getting 5, get 4 or 4.25 on something that's cashable. So that you have the ability that if the markets really turn around within that year, you can actually shift from maybe that cash or cash equivalent back into the markets. And again, I'm only suggesting this if people already have cash. I'm not really suggesting that people are selling from equities or stocks and buying GICs. So again, it is situational. It is a lot more attractive because again, as rates go up, GICs are paying anywhere between 4 for cashable to 5, if not more. The longer you lock it in, the better the interest rate. So it is situational, but if folks have some questions about it, by all means, send us an email or give us a call and we can chat about it and whether it's applicable for you and the family. Okay. And then perfect. I had one other question, and I'll wrap it up here because you guys have been more than gracious with your time as we're walking through this. I have somebody here that says, hey, what about crypto? Okay, he talked about crypto. And what it says is now a good time to maybe start adding it. Folks, crypto is really tough. Okay. It has been really beat up. As I mentioned, in the last year, it's down 75%. But I think with what's going on right now, there's a lot of uncertainty. There's always been some uncertainty. Okay. But more so now than ever, because with FTX claiming bankruptcy, what we're seeing is that uncertainty leak into some other crypto companies. And now they're actually having to halt their businesses as well. So from our point of view, the asset class is very speculative, doesn't pay any income. It's very unregulated. There's not a lot of oversight. And that's what they're recognizing. And when I say they, that's what the regulators and the Securities Commission is recognizing, that this sector has to become more regulated. Okay. And that's been the whole thing with crypto. The one benefit, people say, hey, it's not regulated by Securities and Commission. That's one of the benefits. But the drawback, because it's not regulated, we're going through these bankruptcies that again, some of the major players are going through right now. So I would hang tight. If you're going to do it, I would do it and own it. I would own it in a wallet, so that you have your hands on it. But it's not something that I would run out and do from an investment point of view at this point. Okay. But it's definitely something it's a good conversation, but it carries a lot of risk. Okay. So, okay, folks, listen, I promised to chat for about 45 minutes to an hour, and we're right on that. So again, thank you very much for joining us. I don't anticipate having another one of these sessions for the balance of the year, but likely in early January. So I guess, from my point of view, from my family to obviously your family, we want to wish everybody a safe and happy holidays here. It's hard to imagine we're actually saying that, but we're really roughly 4 to 4.5 weeks out. So we wish everybody all the best. We look forward to seeing everybody in Q1 on the next session. We'll definitely send out the details here shortly. And enjoy the rest of your Wednesday. And if anybody has questions, we're here. Like I said, give us a call, send us an email, and we'll be sure to touch base to provide comments. So in the meantime, guys, have a great day. We'll talk to everybody soon. Thank you for joining us.